Good evening and happy Tuesday. Thanks for joining me for Tuesday with Terry here. Hey, I'm Terry Fleming with Caldwell Banker Hedges here in Cedar Rapids, and we're going to talk about all things real estate starting tonight and hopefully do a bunch more of these in the future. Tonight we're going to focus on mortgages and the 4 different types of mortgages available to you out there. And during this past week, I've talked to some of you guys out there. I've done some promotions also saying we're going to talk about credit scores. And I am briefly going to touch on that tonight. There was just so much information I wanted to divide it into 2 different shows. So next Tuesday, I'm going to do a show specifically geared toward your credit score and how to improve it. So like I mentioned, I'm going to touch on it. But if you do have questions or comments, please reach out to me tonight. I'll be happy to address those before next Tuesday. Few housekeeping items before we get started tonight. Full disclosure, we're going to be talking about mortgages, but I am not a mortgage lender, you guys. I'm a real estate agent, but I'm kind of jack of all trades. I know a little bit about everything. I talk to lenders every day. I have clients that are going in to get pre-approved every day, so I know what's going on in terms of interest rates and all the different options out there. So full disclosure, I am not a lender. Second thing, if you are just starting the home buying process, this video is going to be great for you, so please pay attention. If you have already been pre-approved for a mortgage, please keep watching also, because there's going to be a few tidbits in here you might not know. And in fact, if you have been pre-approved for, say, mortgage A already, listening to this show, you might start to rethink some things and say, maybe mortgage B might be a better option for me. So pay attention, you guys. Let's jump into this here. If you guys have comments or questions, please put them down below. If you don't mind sharing them with everybody. If you want to message me in private, please feel free to do so, and I will get back, answer any questions that you guys might have after the show. Now, grab a pen and paper. I'm going to write some websites down, take a few notes. So grab that pen and paper, get ready to take some notes, and we'll dive right in here. First thing, just in regards to the credit scores, the number one question I get asked all the time is, if I go start shopping around for a mortgage and all these lenders are going to pull my credit scores, is my credit score going to go down? And the answer is no, but you need to do it in a systematic way. You got to go shop around within a 1 to 2 week period. And if you have 2 or 3 lenders pulling your credit, the credit bureau is going to know what you are doing, and they're going to consider it one soft pull. And your credit score might go down 4 or 5 points. It might not go down at all. So in the whole scheme of things, it's not that big of a deal. Now, if you know what lender you're going to go to, go ahead, go to them, have them pull it. It's not going to affect your credit score, okay, you guys? So please do not worry about that. Next, once you find that lender, he is going to pull 3 credit scores for you. Now, the first one is going to be a low one, the next one's going to be the middle one, and obviously the third one is going to be the highest one. He is going to take that middle score, and that middle score is going to determine what type of interest rate you're going to get and what type of mortgage you're going to get. So he's not going to take the average, he's not going to take the lowest, he is literally going to take that middle score. All right? Last thing about credit scores before we move on to mortgages here. There's 3 key numbers that I want you to remember. The first one is 740. I'm just going to write that down here. 740 or above. If you have a credit score of 740 or above, that is the gold standard. You are going to get the best interest rates, and you're going to have basically the pick of any mortgage that you want to have. All right, so 740 is what you want to strive for. Now, the next number is 640. If you have a credit score of 640 or greater, you're going to qualify for most loans, which is awesome. And a lot of people fall within this range right here. So 640 or above, you're going to qualify for the majority of loans out there. Last thing, and don't just get discouraged if your credit is below this. There is one option still available here, and that is the number 580. If you have a credit score of 580 or better, you can possibly get approved for an FHA mortgage, okay? So if you're hovering down around this number, reach out to me. We can try to see if we can get you approved. There have even been cases where people have gotten approved with credit scores lower than that 580, you guys. So just keep that in mind. Join me next week. We're going to talk about this a whole lot more. But I just wanted to kind of give you some basics before we jump into the mortgages. Again, comments or questions, please leave them below. All right, so jumping into the mortgages here, there's 5 words or 5 items I want you guys to understand before we get into each type of mortgage. The first one, you guys, is closing costs. Now, closing costs are basically what the bank charges to process your mortgage, and it's just one way for them to make some money. So around here, the local lenders typically charge anywhere from $1,500 to $2,000, and that's actually really good. In other parts of the country, closing costs can run $7,000, $8,000, so we're pretty lucky here living in this area. All right, now we're gonna get into some of the other types of loans, and there are gonna be some loans that do have higher closing costs, but if you're getting a conventional loan, closing costs between $1,500 and $2,000. Last thing about closing costs, we are going to get the sellers to pay that for you guys. I do not want you guys to have to pay for that out of your own pocket. So very commonplace nowadays, we write it in the contract, we ask them to pay for it, and especially if you are buying a house under $200,000, 99% of the time the sellers are going to do it. Now, if you're buying a house for $300,000-$400,000 and you're putting 15-20% down, it's kind of rinky-dink if we're asking for closing costs and the sellers are going to be like, what are you doing? But in the majority of cases, like I said, if you're getting a mortgage under $200,000, we're getting those sellers to pay those closing costs for you guys. All right? Next thing, down payment. Down payments, you guys, everyone thinks, oh, I need a down payment of 20% in order to get a mortgage. It's not the case, okay? Excuse me. Right now, lenders are giving you mortgages for 0 down all the way up to 20% down. So don't be hooked on that 20% number. The majority of my first-time buyers are buying houses without putting any money down. All right? Third thing, earnest money. The way I like to explain earnest money is it's kind of like if you were going to go rent a place, it's like your rental deposit. It's a deposit we're making to the seller. So what happens is when we write that offer, it's going to sit in a checking account. And if everything goes smoothly with the transaction, at closing, you're going to get that earnest money back. If you are putting some money down for a down payment, then that is just going to go towards the down payment. The thing is here, if you guys decide, oh, in the middle of the contract, I don't want this house anymore and I'm just going to walk away, the sellers do get to keep that money. So it's a little bit of an insurance that you're going to go through with the contract and honor what you have written, okay? So that's the earnest money. Number 4, an ARM. The term ARM means adjustable rate mortgage. And in some people's minds, it's kind of a bad thing, but it's really not. If you think about this fact, for the majority of people, everyone moves, they say on average, every 7 to 8 years. So if you're getting an adjustable rate mortgage that adjusts every 5, 7, or 10 years, you're gonna be out of the house by the time that thing adjusts anyway. So it's really not that big of a deal. If you were gonna buy the house that you're gonna live in for the rest of your life, it's gonna be your dream home, the home you're in, maybe an adjustable rate mortgage is not for you and we wanna stick to that fixed rate loan. But we'll get into an ARM a little bit more, but they are not a bad thing. They work out really good for a lot of people in a lot of cases, okay? Last thing, PMI, what does that stand for? It stands for Private Mortgage Insurance. Now, that mortgage insurance, it doesn't protect you, the borrower, it actually protects the lender, okay? So if you default or go into foreclosure on that loan, the lender's gonna get paid for that house, okay? So, why is PMI kind of a bad thing? Well, if you're putting less than 20% down, they're gonna say you have to pay PMI, okay, you guys? And what is the cost of that? It's basically about $60 to $80 a month that they're gonna tag onto your mortgage. Now, we'll get into it again, but there's ways that we can get around not paying the PMI, but I just wanted to let you know, private mortgage insurance, it benefits the lenders, not you, and it does add up over time, you guys. All right, let's start here. I'm gonna get this erased. We're gonna start with a loan called the USDA Loan. It stands for United States Department of Agriculture. So you're thinking, what in the world are they doing giving out home loans? But they are part of it, and the reason they're doing it is because it's a rural development loan. They want to promote home ownership in small communities and rural places. So here in Iowa, that's obviously a very good thing. If you're buying a home in Cedar Rapids and Marion, you're not going to qualify for a USDA loan. If you're purchasing a home out in Benton, out in Keystone, up in Central City, those are going to qualify for a USDA loan, you guys. Let me put the website down here. It's www.rd.usda.gov. Okay? So once you are here, if you do want more information on a rural development loan, and we'll go into some of the specifics here, but this website is going to give you tons of information. Once you get to the website, go to Programs and Services. Programs and Services. Once you get into this tab, just go on down to Single Family Housing Programs, okay? And I just shortened it, but on the website it's actually Single Family Housing Programs. This website, there's going to be tons and tons of information, but let me go over some of the bullet points of this loan. Number one, you must occupy the home. So you can't buy a house and use it as a rental. You must live there. Number two, your credit score. You need a credit score of 640 or greater to qualify for a USDA loan. So they're being pretty generous in terms of your credit score. So we can go all the way down to 640. Now, one of the nice things about a USDA loan is it's 100% financing. That means no down payment. They will fund the entire amount of the loan, so you don't have to bring anything to closing. Very, very nice. Now, since you're not putting any down payment, you're thinking, oh, I gotta pay that PMI, then they're gonna tack that onto my mortgage. But they're not. With a USDA loan, there is no PMI, monthly PMI anyway. What they do is there is an upfront premium of about $2,000. And there's a couple options here. You can either pay it up front or they can roll it into your mortgage for you. But it is a whole heck of a lot cheaper than paying the $60 to $80 for the life of the loan. So in regards to PMI, no monthly PMI for USDA loans. There is some income eligibility with USDA loans, you guys. And this varies year to year. And if you get onto this website, you're gonna find some more specifics. So one of the things is, it depends on the number of people living in the house. It also has a minimum income that you have to make and a maximum income. So for example, and I'm just throwing these numbers out there, if you have 3 people living in the home, the minimum income to qualify for a USDA loan might be $36,000 and the maximum might be $80,000. So again, that changes all the time and there's different income limits for different areas. So if you are interested, check it out on this website. Last thing, it takes 40 days to close on a USDA loan. So from the time that we write an offer and it gets accepted, it's going to be 40 days until we sign the closing documents and you can move into that home. So it takes a little bit longer just because it is a government loan and there's more red tape that and more paperwork that you have to do. So that's that one. Number 2, one of my favorite loans. It's a VA loan. What is a VA loan? It is a veterans loan. So if you have served in our military, you can qualify for this loan. And there are some awesome benefits to this loan. Number 1, you can purchase any single family home or an approved condo. Now when I say approved condo, all condos have a HOA or a homeowners association. And in Cedar Rapids, about 40 to 50% of the associations are VA approved. So we can get you into a house or a condo. Number 2, unlike the USDA loans, there's no income requirements. So obviously you have to have some income to make sure that you make your monthly mortgage payment, but there's no maximum. So you literally could be earning $1 million a year and you still would qualify for a VA loan, all right? Next, loan limits. The VA loan program will loan you money. They will loan you up to $410,000 for a house, okay? And that's just in 2017. It will vary slightly from year to year, but if you qualify in terms of income, they'll give you $410,000 to go buy a house, all right? Next thing, just like the USDA loan, it is 100% financing, okay? They're gonna give you everything. You do not have to come up with a down payment at all right? Next thing, you guys, credit score. Credit scores can vary a little bit with a VA loan. Typically, the lenders want to see you at a score of 620 or above, okay? 620 or above for a VA loan. Now, there are specific lenders giving out VA loans, and with the local lenders here in town, they will look more on a personal basis. So if you are a little bit below that 620 mark, do not get discouraged. They will take an individual's account into their determining of the loan, and there have been people that do get VA loans with credits under 620, okay? Before I go any further, I did forget, I'm going to throw up the website here for VA loans. So what we're going to do is we're going to go, if you are interested in a VA loan and want more information, www.benefits.va.gov. And at this website, you're going to be able to find out more information. And I apologize for not putting that up there sooner. If you go /home loans, you'll go right to the home loans section. So that's going to give you all the good stuff here. So I apologize, but this is the website that you want to go to for more information on VA loans. Now, we'll get back here. A couple more things in regards to this. Interest rates are really low on VA loans, you guys. They're going to be lower than an FHA loan. They're going to be typically lower than a conventional loan. So, great interest rates. Closing costs. VA loans are a little bit more. Typically, it's about $3,000 to $4,000 for closing costs. So, once again, we can ask the seller to pay for part of that or all of that. So, that's the VA closing costs. Now, how long does it take to close on a VA loan? Typically, again, just like the USDA loan, is 40 days to close on a VA loan. Lastly, because we live in the state of Iowa, you can qualify for a $5,000 military grant. The state of Iowa will give you a grant, literally just give you the money, $5,000. You have had to have served 90 days in the military. Those 90 days do not need to be consecutive, but you have had to have served 90 days. So now they're great benefit for being in the military. Okay, next loan, you guys, is the FHA loan. Now, FHA loans are good for people with maybe credit that's not so good. All right, so here's the guidelines on the FHA loan. And when you look up FHA loans online, you guys, these guidelines do change all the time. So if I'm quoting you something now, it could be totally different in a month or two from now. But here's what's going on right now. Typically for an FHA loan, you need 3.5% for a down payment. All right, so for example, if you were purchasing a $100,000 house, you have to come up with and put $3,500 down for that house. Now, that is with a credit score of 580 or better. I mentioned before at the very beginning, there have been times when people can get qualified for a FHA loan with a score lower than that 580. And that can happen. If it does, you have to put 10% down. So again, in that example of the $100,000 house, you would have to come up with and put $10,000 down. But they can get you qualified if you can come up with that down payment. All right? One other nice thing about the FHA loan, so they have lower credit score requirements, and if you have had a bankruptcy or a foreclosure that is over 2 years old, you can qualify for a loan. So if, let's say, you had a bankruptcy that happened 3 or 4 years ago, go ahead. I think you'll be able to get that FHA loan. It has to be longer than 2 years out. So it's something to keep in the back of your mind if one of those circumstances did happen to you in the past. All right? Now, one of the bummers with the FHA loan is you have to pay the PMI. So that's going to be a monthly fee that gets tacked onto your mortgage. And again, it's going to be anywhere from probably $60 to $80 a month. Now, that is not going to fall off. That is going to be there the entire life of the loan. So if you have that loan for 15, 20 years, you're going to be paying that extra $60 to $80 for 15 to 20 years, okay? Something to keep in mind. So if you do get an FHA loan, that's great, but as soon as you can refinance and get out of it, I highly recommend it, all right? So you must pay PMI. Next thing, the house must pass an FHA appraiser. So what happens is, normally when you go out to buy a house, an appraiser is going to go out there. For an FHA loan, they're going to send a separate appraiser out there. He's going to look at the basically the roof, the windows, the sidewalks. He's going to look to see if there's any chipping paint. So he's going to look at safety concerns with the home. If it passes with that, great, he'll approve the loan. Next thing, how long does it take for an FHA loan to close? Again, it's going to be a minimum of 40 days to close just because it's a government-backed loan. Last thing, how much are closing costs for the FHA loan? Again, they're going to be a little bit more expensive. They're going to be about $3,500 to $4,000. And again, we want to ask those sellers to help contribute some toward that or even pay it all for you guys, all right? So that's the FHA loan. Last but not least is the conventional loan. Now this is the most common type of mortgage out there, you guys. The majority of my home buyers, this is what they get. So credit score wise, to qualify for a conventional loan, you need a credit score of about 640 to 660 or greater. And like I mentioned in the beginning, if your credit score is 740 or greater, that's when you're going to get those great interest rates. Those interest rates are what you hear advertised on TV or on the internet or things like that. So you're going to qualify for those best interest rates. In terms of a down payment, there are so many options here, you guys. Again, old school thinking, you need 20% down. Sure, they're going to let you do 20% down, but there's so many more options available nowadays, you guys, and especially with local lenders here in town, whether it be a credit union or a local bank, they will work with you. The majority of my first-time home buyers do 0 down payment loans, and they do not have to pay the PMI because the lenders are able to work around that and kind of maneuver things so you don't have to pay that. So whether you're putting 0 down, 3% down, 5%, 10%, they can get it so you can avoid paying the PMI. And again, we can kind of go into discussions on that later. So down payment, tons and tons of options. Conventional loan, you can do a 15-year fixed, a 30-year fixed, a 20-year fixed. So you'll have that fixed interest rate for all of those years. And again, like we talked about earlier, there are some options for an ARM loan also, which is that adjustable rate mortgage. Last thing, how long does it take to close a conventional loan? And you know what? It only takes about 30 to 35 days. So you're going to get into your house about a week to 10 days faster than if you do those other loans, just because they don't have so much paperwork. It's not a government-backed type loan, so we can get you in a lot quicker. All right? So those are the 4 main loans that people in our area use to purchase a home, okay, you guys? There's great programs out there, and if I'm honest, you should use a local lender. And when I say local lender, I'm talking about like the University of Iowa Credit Union. I'm talking about Hills Bank, Bank Iowa, Farmers State Bank, Collins Community Credit Union, Lynn area. Those are your local places that you want to shop. They're going to deal with you more on a one-on-one basis, whereas if you go to a big bank, say Wells Fargo or something like that, you're really not going to get maybe as personal of an experience. They're not going to work with you as much one-on-one. So, just my opinion. Last thing in closing here, you guys, I just want to thank you for tuning in tonight. If you're watching this on repeat, thanks for watching. Couple things. Why is it a good time to be buying a house right now? Lots of reasons, actually. We're going into autumn here. So what that means is there's fewer buyers out there in the market. So there's going to be a lot less competition, which is always a good thing. You start looking in April and May, there's tons of buyers out there. This is a great time. Second of all, interest rates are still really good right now, you guys. Who knows what's going to happen 6 months or 12 months from now. So if you can get that interest rate locked in right now, you're going to be doing yourself a favor and have lower monthly payments. Third, the sellers that are selling right now, they're motivated. They want to get their house sold before winter comes. So again, it's just another little excuse why in the fall, in the autumn, it's a good time to be purchasing a home. All right? Thank you again for joining me. One last thing. Next Tuesday, I'm going to be talking about credit scores. Please join me then. And last thing, my buyer services are free, you guys. I will take you out, we'll look at houses, and I'm going to be the one doing all the work. I'm going to write the contract for you, help with negotiations. I'm going to take you through the whole inspection process. I'm going to take the paperwork through escrow, through the appraisal process, and I'm going to get you to closing. So literally all you have to do during those 30 to 40 days is get packing, get the boxes, and get your movers lined up. I will do the rest. My buyer services are free. please contact me. I would love to work with you, and I hope to hear from you soon. Thanks for joining me.